Hey everybody, welcome to Money's No Object. I'm your host, Dylan Howell. This is episode number 446 of our YouTube channel and podcast, and I could not be more excited to continue sharing with you guys personal finance topics that I think could be useful for you in your long-term financial journey. Today we are going to continue this process of doing Stock Market Mondays. And I'm really excited about this one, specifically because a lot has happened in the past week. And if you've been paying any type of attention, I'm sure you will not be surprised as to what we will be talking about today. There were some very big things that happened in the market, and I just want to sit and talk about what those were and what they look like, and then talk about some more general things as well, because there are some very specific things that occurred. But nonetheless, I just want to keep us all up to date, knowing what's going on, and that way you guys and myself can talk a bit more, whether it's in the comments or whether you ask me questions directly as to, hey, what's going on? What should I be thinking when it comes to markets right now? Or just more interesting questions, which I'm sure there will be some about the things that we talk about today. So stick around for a discussion of all that and more in today's episode. Before we get started though, if you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below, and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcasts, be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan. And that's really good supplemental materials to all the things I'm putting out in these long form episodes on YouTube and the podcast every single day. And then if you need somebody to help you to build a financial plan and keep you accountable to that plan over the long term, that I can do that, just DM me on any of the major social media sites and tell me that you are interested in financial coaching sessions. And you and I can begin working together, pushing towards your long-term financial goals and ultimately pushing you on towards long-term financial freedom, which is what I hope for every single individual who's watching or listening to this show on a day-to-day basis. Now, the first thing I want to talk about today, just so we can get it out of the way, is the thing that has been pondered and pontificated over ad nauseum all week, right? It's just been, beaten to death, but I haven't talked about it. So, of course, I want to talk about it with you guys. And that is the whole Elon Musk Twitter situation. I mean, how could you not talk about this if you're following markets at all right now? And it's pretty remarkable what he is attempting to do, but the question is, one, will he be able to do it in the first place? It's already looking like probably not in the way that he had hoped. And then two, what could be the outcome for shareholders and for the market at large? How does this impact things? So we'll just dive right in. So if you didn't know, Elon Musk offered to buy all of Twitter this week, right? So the big news previously was like he picked up over 9% of the company's stock, which is a substantial portion of any company's stock to take on, right? Owning 9% of a company is pretty substantial, especially when you're talking about a company that's worth tens of billions of dollars. Now, what he did this week was he offered to buy Twitter for $54.20 per share. Now you're saying, okay, that doesn't mean anything. And if you guys know anything about share prices, that doesn't mean anything, right? Share prices literally just mean how much a company is worth in the market per share outstanding, right? So having a $54 stock price versus a $50,000 stock price makes no difference. The only thing that makes any difference is that stock price times the number of shares outstanding. So stock price really doesn't matter, but except for when you're talking about the market cap at large. So he is looking to buy the company at a market cap of around $43 billion, when currently they're trading at about $34.42 billion. So it's a substantial premium over what shareholders are currently getting. So this is very interesting. This is something that everyone has talked quite a bit about, and I'm glad that a couple things got digested and kind of played out before I talked about this at all. Because if I just came and told you that he offered to buy Twitter, that's kind of boring, right? But some other things have occurred. Now, I just want to read you some things that he said in the letter that he wrote to the chairman of the board in a securities filing. He said, "I invested in Twitter as I believe in its potential to be the platform for free speech around the globe, and I believe free speech is a societal imperative for a functioning democracy." Let's see. He also said that he wanted to take them public, and he said that Twitter has plenty of potential and that he would unlock that potential, which is all very enticing, very interesting, very, very crazy. Now, the reason I think that we all think it's crazy is because it's one man, right? One man trying to purchase an entire company. Like that's outrageous in our minds. But with a man like him who's got a net worth of 300 plus $billion, 43 billion is a little over 10%, 10-15% of his net worth. I mean, it's not so substantial, especially when you're buying another large tech company. So what does this mean? Why does this matter? Why is this particularly interesting? Well, what we learned a lot about this week was how this type of takeover, how this type of acquisition technique actually works, because rarely do we see it. Rarely do we see a billionaire decide, hey, I'm just going to buy all of this myself, right? And if we do, it's not a company as high profile as Twitter. So Elon going after Twitter becomes very interesting. And we saw Twitter's board decide on Friday that they were going to enact something that I don't think a lot of people know what it is, right? They put in place a shareholder rights plan, or what is also better known as the poison pill. Now, poison pills come in many different forms, okay? But basically what a poison pill is it is this anti-takeover provision, right? It is this provision that companies can put in place at any time, right? They don't just get to put it in place after the fact, and they don't have to have it in place forever. But this would be the exact type of situation where a poison pill can become useful, because after Elon put in his offer, the board got together and enacted this poison pill, basically saying we don't want you to buy up all of the stock. And basically saying we're probably going to reject your offer. And this poison pill, like many others, is in place to keep Elon from buying so many shares, so to keep Elon from buying over a certain percentage of the company stock. In this particular instance, it's over 15% of the company stock. If they buy, if any shareholder, but specifically Elon, if he were to buy more than 15% of the company stock, then they would allow all other shareholders to buy the company stock at a discount and not let Elon buy anymore. So it would dilute Elon's position and not let him take over the power that he wants to, right? And make it far more difficult for him to gain all of the leverage that he wants to gain in order to take over the company. Now, some poison pills, not this one specifically, but some poison pills have, these, rights in place where if you get over a certain percentage of the stock, then it'll just turn into a natural share offering to these other shareholders where they don't have to buy anything. They just immediately issue new shares to those shareholders. Now, it dilutes everybody, but it specifically dilutes the individual or the company, the institution that is trying to take over whatever the firm is. So they put this in place, right? Twitter puts this in place this week, which is super interesting because again, we just don't talk about them much. We don't know what they are. Not we, as in myself, but most people don't know what they are, don't know how they are used. So it's interesting to actually see this come into play. So this is undoubtedly going to deter Elon in some way and is likely going to be used in the rejection of his offer to try to thwart his plan B in any way. And then the question is, what's plan B? My guess is that it's going to go into some type of proxy war, right? Where you have shareholders who get to vote for the controlling interest of the company, and most shareholders typically proxy their votes to like the CEO or somebody on the board, the chairman of the board, whatever. But it's likely that Elon would go about trying to get shareholders to proxy their votes to him. Which I don't know if that would be successful or not, but it may be something that he attempted to do in taking over. And this has even gotten more interesting because there's one report out that even talks about how a private equity firm has already come into Twitter since, they don't seem open to Elon, but maybe they're more open to takeovers from elsewhere or companies who are willing to pay higher premiums than Elon was. So a private equity company came in and said, hey, we'll take you private for another amount. I don't remember what the amount was that they brought to the table, or even if it was disclosed. But nonetheless, this is not going to be just a one-man offering to try to take over Twitter. There are no doubt going to be other companies in the mix. Not to mention Mark Cuban, which many of us know and love from Shark Tank and owning the Dallas Mavericks. He tweeted talking about how Google and Facebook and other big tech companies are no doubt talking to their antitrust lawyers, talking about, hey, can we get in on this? Because they have far more available. Well, I would say far more, but it's all relative when you get up there in the hundreds of billions. But they have more resources available to them than does Elon. And if they could take over Twitter, that might be something that's more organic, but it may totally thwart the ideology that Elon had when he was like, hey, free speech needs to be a big deal and all this type of stuff, right? So we can learn a lot from this. It has by no means been resolved. It's by no means over, but we can learn a lot from this as far as how the market works, how these takeover attempts work, how the richest man in the world thinks, how other companies react to these types of actions that are taken. But it's all very interesting. And what's all the more interesting, I think, is, if you would have invested in Twitter a month ago, you'd be up 20% for really no other reason than the fact that Elon invested. I mean, from the day before we knew that Elon invested to the close that next, I guess it was a Monday, the stock was up over 27%, right? Now, the interesting thing about Twitter, though, is that if you go back to their IPO back in 2013 and just go all the way to today, the stock's up 8%. And if you just back up, I mean, a month, right? The stock would have been down 20% from its IPO. So this is a stock that's, by and large traded sideways for most of its life. And I don't know, a good investment. I don't necessarily know at this point. I would, I'm not invested in it. I'm, steering clear from all the mayhem. I mean, obviously, if you were invested pre-Elon or if you were invested pre-pandemic, if you were invested pre-pandemic, you're up almost 100% at this point. But I mean, to have that kind of hindsight. I mean, hindsight's 2020. It's not predictive. I mean, we can't look back and see what happened and then predict the future with a great deal of certainty. So. Nonetheless, this is what's going on with this company that many of us know quite a bit about and have interacted on the platform and all these different types of things. So just wanted to go over that real quick. Now we can jump into some other broader market type things. Now, if we just look back at this past week, this past week, the market down, the S&P down 2.26%, the NASDAQ on the week down 3.47%. So it wasn't a fantastic week for financial markets. There's still headwinds that are just right square in our face that have not gone away and don't seem to be going away anytime soon. Obviously, the geopolitical things are still going on, but we talked about a couple weeks ago how even geopolitical things don't tend to just hold markets back long term. We tend to shake those things off pretty easily. Even though it's a potential headwind, I think markets are still far more interested in the big things that are holding us back, being inflation, prices, interest rates, the Fed, all these types of things, right? Because the Fed has made it very clear, first of all, that they are going to start shrinking their balance sheet pretty aggressively relative to what was expected, even months ago. And so this is going to have a very substantial impact on firms' costs of capital and their ability to raise money easily and cheaply. And so it's going to get far more difficult on a relative basis, right? Some companies are always going to be able to borrow or always going to be able to raise capital quite easily, but not as relatively easy as it has been in the recent past. But all that's driven by this inflation that we have been having. So prices in March, right? We got the inflation reading this past week, up 8.5% in March compared to 2021. And the headlines driven by energy costs, partially true, right? The White House has come out and they're calling it, the Putin price hike. And I don't give this a whole lot of validity, specifically because prices were on a steep upward trend even before there was any Putin issue, right? Maybe they're saying, oh, it would have peaked earlier. Could that be true? Potentially. But ultimately, the ability for Putin to have that type of impact on prices is, not quite as substantial as we may think. I mean, we can even look at gas prices as recently as the past few weeks and compare those to, a month and a half ago when all this stuff started kicking off. I mean, I don't know about where you are, but gas prices have, seem to. I kind of watch and see, what prices are doing. They peaked where I'm at in Texas. They seem to peak around $4.09, $4.10, somewhere around there, $4.15. And now we're back down into the 340s. So substantial declines in energy costs, especially in the past few weeks on the oil front, right? So I wouldn't go as far as calling it the Putin price hike. But I would say that you look at these numbers and prices have hiked no matter whose fault it is, right? Prices have absolutely skyrocketed upwards. So just to give you a little bit of perspective, right? If you backed up to, this is, this most recent reading was from March. So this year, March of 2020, inflation was at 1.5%. We're sitting here 2 years later with a 7% difference from that particular month. So inflation year over year was 8.5%. Inflation has not been this high, let's see, since 1981, December of 1981. I believe that's what I'm seeing on this chart here. So December of 1981. So this is really unprecedented for most people who are, in their 30s, even 40s, maybe even 50s, right? Because, in 1981, people in their 40s were just little kids. We didn't know, anything because people my age weren't alive yet, right? But people in their 40s, people in their 30s, the 30s weren't alive yet, but people in their 40s, they were little kids. They hadn't really dealt with this type of inflation yet either. So this is just uncharted territory, right? And in the same way that it's uncharted territory for us, it is also uncharted territory for companies and uncharted territory for the Fed, because even these older individuals who have worked in the Fed for a long time, we're talking 40 years ago that inflation was as high. So, many of them weren't working in the Fed 40 years ago. Some of them weren't, working really at all 40 years ago, or doing anything, of this substantial, magnitude of having to deal with the nation's inflation, right? So this is it's all brand new. It's all very difficult to see. And I talked about, the companies that are being hit hard by this. It's not just the CPI. When we talk about inflation, typically we talk about the CPI, which is the Consumer Price Index, right? It is what we are paying for this basket of goods and services. But the suppliers, the producers, they have also seen higher prices as well. So the PPI, the Producer Price Index, which measures the prices paid by wholesalers, increased 11.2% from a year ago. So what do we see? We see that, yes, consumer prices have increased, but they have not increased, at the rate that the prices of the producers have increased. So we're actually not feeling the full brunt of the price increase, right? There's actually, a little less there on the price increase than we had seen previously. So this is also very interesting. So stripping out food, energy, and trade services, the PPI, Producer Price Index, rose 0.9% on a monthly basis, nearly double the 0.5 estimate, and the biggest monthly gain since January 2021. Core PPI increased 7% on a year-over-year basis. And PPI is considered a forward-looking inflation measure as it tracks prices in the pipeline for goods and services that eventually reach consumers. So what this is saying is that the prices that these producers have paid, that they will likely push right on to consumers in the near future, is quite high, right? It's higher than the CPI number. So those who have said that inflation has peaked may not be right on track, right? May not be exactly correct. They may be correct. Who knows? I've told you guys before. Forecasting these types of things is very, very difficult to determine if things are just, at their peak or not when it comes to these macroeconomic factors. But nonetheless, inflation is a real deal. And it's even, more real when you talk about, okay, well, the Fed's talking about raising interest rates, and not just raising them at the rate that they just did, 0.25%, but talking about, multiple 0.5% increases, which we already see reflected in mortgage rates, which we are seeing reflected in the rates on many other loans and treasury bonds and all those types of things. So in all aspects, we're seeing some very, very strong headwinds to the growth of our economy. Now, what's that going to do to the stock market? Well, it becomes pretty hard to tell. Like, one, is the Fed just going to be way, way too late, and this is going to get out of control? We don't know that yet, right? Or is the Fed going to do enough, right? And is everything going to be okay? Again, hard to tell. Who knows? But I'll tell you this: if you go back and you look at the S&P 500 in 1982, now I know 1981 was the last time we had inflation this high, but let me look back at this chart. Even throughout 1982, we're talking inflation that was over 4% for much of that year. If you go from 1982, and all of the chart goes back as April 23rd of 1982, and you go, let's see, to the, I don't know, let's go 5 years, right? So we can go April of 1987, right? You go, or let's say May 1st, 1987. The stock market was up 142.78% from April 23rd, 1982 to May 1st, 1987. So if we get 142.78% between now and 2027, April of 2027, I think we'd all be thrilled with those types of returns. So just know that high inflation and the back end of high inflation doesn't always lead to just horrendous, prices on the other side for assets, right? Is it going to have a very real impact on bonds? Sure. Is it going to have an impact on your budget and your ability to buy things? Sure, because wages aren't growing as fast as the price of goods and services is. But nonetheless, being invested, this is a stock market Monday, right? Not a pocketbook budget Monday, even though I talk about those things all the time. Investing is probably not going to be far different than it has been. Now, is that to say that we're going to make gains every year and we're going to be growing at 15, 20% a year, kind of like we have been in the recent past? Probably not. But does it mean that we can't continue to grow in a substantial way? I don't think so. I think that we absolutely could continue to grow. And there's always a reason to be bullish. I mean, the past always gives us very, very, very good reason to be bullish. I mean, there's a reason that I talk about investing in the stock market so much, because I believe in it, because I believe that is, the best way for the vast majority of people to go about growing their wealth substantially. So I teach this all the time. I tell you guys this all the time. And it's not just me blowing smoke. It's absolutely me telling you what I do, how I think, and ultimately trying to, provide some confidence for you, right? Trying to provide you with this good sense of the fact that, hey, even if, the market's down, even if, because it's not like, markets are hitting all-time highs. How quickly we forget that, it's been a while since we hit an all-time high. You go for the S&P 500, we hit our all-time high back in late December. And from there, still down 8+%. You go and you look at, the NASDAQ. When was the last time the NASDAQ was at an all-time high? The NASDAQ was at an all-time high. Let's see this chart. I think it was a little higher back in late November than it was in December. But, even from that peak, the NASDAQ being down nearly 17%, we're talking some pretty substantial pullbacks from highs. And yet, that is pricing in a lot of this negativity, pricing in a lot of these bad things. And guess what? If you took prices today and you went backwards 5 years or backwards 10 years, those average stock prices are still going to be substantially better than average, substantially better than what we are used to as investors. I'm not saying we, because I've been spoiled as I'm a younger investor, and many of you are as well. You're spoiled by these amazing asset prices that you've seen, but over a long period of time, you go backwards, you ask people who are in their 40s or in their 50s who've been investing, ask them about the last 5 or 10 years, and they'll probably tell you that it's been some of the best years of investing that they have ever had, and they would not be lying to you, right? So my whole point of these stock market Mondays is not only to tell you what's happening, right? Tell you about Elon Musk and Twitter and poison pills and all the rest, right? Or to talk to you about what inflation currently is or what it may be in the future or whatever. I just want to give you the confidence to invest, right? I want you to know that inflation is not too much. Billionaires taking, stabs at these other big companies is, not too much to invest through. The war in Ukraine is not too much to invest through. So I just know that even though there are headwinds, even though there are things that are negative, I am extremely positive. And I think that, even if the market were flat for the next 10 years, I'm still investing and you should be too. And we learned that, right? That's a lesson that we have learned in the past. If you just go back, and I know I look at charts sometimes and I don't give them to you guys, and I apologize for that, right? But just do a little work on your own. If you go back to July of 2000, right, and you just take the S&P 500 from July of 2000 to May 25th of 2007, do you know what the rate of return would have been? The total cumulative return on the S&P 500 would have been 0.38%. 0.38%. Almost 7 years later, right? But guess what? If you kept investing, you would have kept investing through a financial crisis that would have taken you down over 50%, right? But if you take that out to today, so we're sitting here almost 22 years later, you're looking at 190.9% return from the top of the tech bubble, right? From the top, right before it all crashed. Right. And so if you just took that and 190 and divided that by 22. So we're talking about from a top to basically a top, right? We're kind of close to a top at this point, given that we're only a couple months out. So 190 divided by 22. That's on average 8.636% per year, which is, that's what you can ask for over a long period of time from the market, and it will provide it, right? So don't even get me into, going from bottoms or going from the bottom of the financial crisis or the bottom of the tech boom to today. The whole point is invest and keep investing in the good, in the bad, keep investing. If you think that things are bad right now, keep investing. If you think things are good right now, keep investing, right? But look at your risk tolerances. Look at what you should do as an investor. Look at what your asset allocation should be as an investor and follow that and just keep pouring money in, buying index funds, buying diversified mutual funds, ETFs, all those types of things. And you will build wealth over a long period of time, right? You will become more wealthy. There's a reason why I gave you guys the what is the stock market for Stock Market Monday last week, because I want you to know what the stock market is. I want you to be better informed, more well-versed in these topics, because I don't want you to have all this uncertainty about investing in the markets and just waiting until you learn, and then you never learn and you fall behind and you never trusted it and all these types of things. I want you to trust it because of what it has done in the past, right? That's the only reason that we trust other people. We trust other people because of what they have done in the past. So if you learn what the market has done in the past, there's really no reason why you shouldn't be able to trust it for the next 20, 30, 40, 50, 60 years of your investing life. So I'll get off my soapbox, but hopefully this gives you some confidence to go invest, do what's right for your money and for yourself over a long period of time. So thanks for watching this video. If you could, go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below, and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcasts, be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan. And that's really good supplemental materials to all the things I'm putting out in these long form episodes on YouTube and the podcast every single day. Then if you need somebody to help you to build a financial plan and keep you accountable to that plan over the long term, then I can do that. Just DM me on any of the major social media sites and tell me that you are interested in financial coaching sessions. And you and I can begin working together, pushing towards your long-term financial goals and ultimately pushing you on towards long-term financial freedom, which is what I hope for every single individual who's watching or listening to this show on a day-to-day basis. So tune in tomorrow as I continue talking about personal finance topics that I think can be useful for you in your long-term financial journey. So thanks for tuning into this episode of Money's No Object. I'm your host, Dylan Howell. God bless.